Hello, everybody. Thanks for joining us for today's podcast, the $1 million M&A question: buy, sell, hold, or fold. Hopefully that fourth option is not one that too many of you are considering right now, but it's certainly something we'll touch on a little bit in our discussion today. My name is Greg Hart of PSMJ Resources. I have with me today Karl Wohler, who's one of our senior consultants on our merger and acquisition advisory team. And Karl, we were able to get an hour of his time in what is a very busy schedule these days with respect to merger and acquisition to kind of give us a little bit of insight on what he's seeing out there. I think there's a lot of questions about has things changed with COVID-19, what's the future look like, a lot of uncertainty. So we'll unpack all that, but Karl certainly is going to share some insight from things that are happening right now. I wouldn't be surprised if just before we jumped on the call and just after we jump off the call, Karl will be working on other calls with clients for purchases or sales. So anyway, Karl works in the M&A team, and also as a result, the way we've structured that team is exposed to a lot of our valuation practice and our internal ownership transition practice as well. Those three things are often very interchangeable: mergers and acquisitions, pure business valuation, and internal ownership transition. So all of our consultants have experience in all three. Karl brings a lot of unique experience. He's been in the engineering space for many, many years. I think actually a chemical engineer by training, if I've got it right, Karl, and kind of moved up in the ranks on mergers and acquisitions on a bunch of different fronts, from investment banking and private equity into being an actual VP of M&A. So a lot of diverse experience, not just finding targets, but how to finance the transactions, how to structure them, and how to do all the due diligence and certainly integrate. So with that, I just want to touch on a couple quick things here before we get into our discussion. I've got a bunch of things I want to talk to Karl about, a bunch of questions, but absolutely, for those of you who are on the live broadcast with us here today, you've got the benefit of being able to ask your own questions as well. So if you look at the panel, we're using GoToWebinar to record this live event today. You'll see a Q&A or a questions module on your screen. Just type in your questions there, and I'll sprinkle those in as we're going through the discussion with Karl. So don't be shy. If you've got questions, if there's something we say that triggers a thought or a question in your mind, just drop it in there, and I'll get to as many as we can during the discussion. Also, for those of you attending the live podcast here, PSMJ is an AIA CES provider, and this podcast has been approved by AIA CES for AIA members and non-members. By attending the live podcast, you earn 1/2 of one learning unit hour or 0.5 PDH credits. To receive that, email your AIA number to customerservice@psmj.com or submit the certificate that you receive after this broadcast to the appropriate board. Please note, not all states and boards accept these types of credits. I should also point out, you'll be receiving, anybody who's registered for the broadcast today, will be receiving a email within 24 hours of the broadcast that will have the link to access that certificate that I just mentioned. It'll include the link to the recording and any other relevant information. So keep an eye out for that. Like I said, within 24 hours, that usually goes out once the on-demand version of the broadcast is processed and ready to go. With that, let's get into our discussion. I don't want to waste any more time here. Let's get into our discussion with Karl. Karl, thanks for being here with us today.
Hey, Greg.
Hey, Karl, maybe just, I've always admired your kind of unique and diverse background in M&A. Maybe you could give us a little bit more kind of context on it. Tell us a little bit about your M&A experience.
So I'm a chemical engineer by training. I spent 20 years at Polaroid in process engineering, R&D, and worked for the CEO in a number of various capacities, including special projects and workout situations. One day, about 25 years ago, I got a field promotion at a board meeting into an M&A role to help solve a problem, and I've been doing M&A ever since. I've worked in many industries in M&A. I've worked for DuPont, Philips Electronics. I've worked in private equity firms in Europe and in the U.S. Spent 3 years in New York City as the vice president of M&A for $1 billion public printing company by the name of Bound & Company. I joined PSMJ 4 years ago, and I've been back to my engineering roots, I guess. and supporting the M&A program at PSMJ. My activities right now are almost all focused entirely on sell-side advisory engagements. PSMJ has internal transition, valuation practice, and we also do buy-side advisory work, but my plate is full with sell-side advisory work, helping owners transition ownership of their business in the external market. And that could be a sale to a strategic or a recapitalization to a private equity or family office. We're doing a lot of that work right now.
Oh, great. Thanks, Karl. I appreciate that. One quick housekeeping note. I saw somebody ask the question. This podcast is audio only. We won't be sharing slides. It's more of this conversation and discussion. So don't be worried if you're not seeing slides come up on your screen. It's purely an audio broadcast. All right. So the first thing, Karl, let's talk a little bit about this kind of earthquake that's hit so many corners of the economy. Before this crisis happened, it seemed to me we were in a real seller's market for AEC M&A. That's still the case? What's your thoughts on kind of how this COVID-19 has maybe changed some of the dynamics of the market?
Sure, Greg. I think it's great to perhaps start with a baseline. And where was the M&A market February before the COVID storm hit? The M&A market across AEC has been very hot and very active, with a little bit of variation, though, I would say. The market coming into the beginning of 2020 was hot and very active for engineering firms, environmental firms, and construction services firms. Definitely a seller's market, particularly in the Sun Belt, where seems more and more firms, if they're doing geographic expansion, they want to expand into the southern climates, following the demographics of the U.S. population growth. I'll also say that private equity and family office investment activity in the environmental, construction services, and engineering space has been very active and growing every month with more and more people entering the space. As you probably know, private equity and family office have trillions of dollars of dry powder sitting in their checking accounts looking for deals, and it's resulted in them expanding into areas including professional services where they've been hesitant to enter in the past. So that's the background for that part of the market, through February and into March. I will say that the architecture segment is very different. We don't know exactly why, but it is not a seller's market. There are fewer strategic buyers in the market and far less activity and interest from the family office and private equity side. So that's where the market was, I would say, February coming into March, and the COVID lockdown and economic upset that we've seen.
Mm-hmm. Are you seeing, and maybe before we get into that, tell me a little bit about, private equity is kind of an interesting dynamic for this industry that hasn't existed at any large degree of scale, I guess, for many years. And I would even argue, look, M&A in the traditional sense, it's only really been a strong force in this industry in the past 10, 15, maybe 20 years. Tell me a little bit about, you think private equity will continue to be kind of a growing option, I guess?
Yeah, so, the roots of private equity is what's known as the leveraged buyout. Go to a bank and get what's referred to as an ABL, or an asset-based loan, and leverage up your acquisitions. With that, you might be able to borrow 60 to 70% of the purchase price with using the collateral of real estate, machinery, inventory, and receivables to get a levered return on your investment. The other reason why private equity was attracted to the so-called smokestack industries is because typically the value in a company is more sustainable and to them, therefore, less risky. Moving to professional services and buying a engineering firm, for example, that's a little bit more challenging for them because the only asset you can borrow against are your receivables, so you need to put up more capital. But also the other challenge is the real value in the business is the so-called human capital, which of course is fugitive. So in any event, that's been a challenge that's held them back, but I will tell you that in the last 5 years, they've come around and they're really moving aggressively into the space. It could be a lack of more money than available deals in other spaces, but I think they're also seeing it as a fragmented industry ripe for consolidation, which plays to their model of always going in and buying several firms to build a platform and get efficiency and value creation through that. Family offices are very active as well in this space, and in fact, for sellers in this market, family office can be more attractive because they typically have 10 or 20-year investment hold periods. Some sellers get concerned about a private equity firm if their intention is to own it for perhaps 3 to 5 years at the most. So in any event, the market is very, very active in that area. And we've closed several, and we're in process on several deals with private equity and family office buyers as well as strategic buyers, and they are competitive on pricing.
Yeah, let's talk a little bit more about kind of, I guess, sort of what's hot and what's not. A long-held thought in just purely in the sense of business valuation is diversity is always better on so many different dimensions. In the M&A market right now, what are your thoughts? One of the questions is a single discipline specialty consulting or engineering firm, in this particular case, acoustics and noise vibration consulting. What are your thoughts on niche versus diverse? Is one more appealing than the other right now as far as buyers go?
First of all, I would encourage sellers and people growing their business to be careful about diversity, because diversity can help you in some ways, but it may also make an exit more difficult. I would urge you, if you're thinking about diversifying your service offering, to Google 2 terms and look up the Wikipedia definitions. One term is conglomerate discount. The other one is pure play. These are terms in the public market that also are important in the private market. And what it basically says is there was always this, and has been for many years, the fact that in the public equity markets, large conglomerates trade at a discount versus pure play specialist companies. And it's because investors like a clean and pure play. When we have companies that have diverse offerings, it is not unusual for buyers to come in and say, I like this half, but I don't like that half. Can I buy the right half of the company, but not the left? We had a forensics firm that also did structural work for cell towers. And we had forensics companies saying, can we buy the forensics half, but not that other half? We would run into this often, and it is a consideration for sellers and owners as they build their business and think about diversity as being, diversity can be helpful, but it needs to be managed carefully in terms of the sale process. I will tell you, buyers typically like a pure play. We have engineering firms that are in, industrial and transportation. We'll have a buyer look and say, I like the transportation part, but not the industrial. So just keep that in mind as you build your company capabilities over the years. Doesn't mean they're not sellable, but it can be a factor for sure. And I will tell you, just from a hot sector standpoint, definitely geographies, anything southeast, southwest, Texas, California, East Coast up to DC are probably the hottest geographies for sure. I think that from a sector standpoint, we see transportation, infrastructure related, very hot. We see people being less active and interested in things related to the housing market. Perhaps concerns that if there's a downturn, housing will get hit first. But again, in general, though, we do see, we are very busy. It is a very busy buyer and seller market across engineering, construction services, and environmental, for sure.
Mm-hmm. Actually, Karl, could you just really quick give a little more explanation about something we talked about a few minutes ago, family office, kind of what that is, maybe an example of how that works with an AE firm?
So a family office are becoming more and more like private equity. Basically, it is high net worth families or groups of families who have recognized the value of being in the middle market. And by that, I mean companies in the range of 5 million to $1 billion in revenue. And in the old days, they would put their money into a private equity fund. And they would get a return. And they would watch that and see and get a decent return, and they would learn that that would be a good segment to be in. But they would also look at the fees that the private equity partners are making on these deals and say, oh my God, these fees are quite high. We have the experience and the sophistication to do it ourselves. Let's go in as the buyer ourselves. But again, remember that like private equity, their goal is not to replace management. Their goal is to partner with management, just like private equity. They'll typically be looking for a 10 to 30% equity role. They want, not because they can't afford to buy 100%, because they want a leadership team with aligned interests and skin in the game going forward, because their goal is to do a buy and build strategy in partnership with management. So actually, if you are an owner that has some internal transition going on and some ownership percentage, say 10, 20, 30% with junior members who wish to continue to be owners going forward, if you sell to a strategic that's a large public company, they will require 100% redemption. Everyone will become W-2 employees. There'll be no ownership path going forward. If you roll over with private equity family office, the younger members can roll their equity. It would be welcomed by the investor partner because they will see the next generation of leadership with skin in the game and an interest in staying long term. So it can be a nice option as an exit vehicle. So
Okay.
something to think about.
Yeah. Let's talk a little bit about it. I've heard several comments and questions over the past couple months that ownership transition, and I mean that in the sense of exit strategies, creating some liquidity, taking some money off the table, baby boomers are looking to kind of get out. So ownership transition was becoming a bigger and bigger challenge for a lot of organizations going into this. So let's just take a typical kind of 25-person firm where the owner was thinking, 2020 is going to be the year where I test the waters, try to sell the company externally. I don't see internal ownership transition as an option, either financially or otherwise. Is this, what do you think about a seller who might want to get into the market right now? Is this a good time to do that? Should they wait it out, or what would your advice be?
Yeah, so I've baselined the M&A market before March 1st. Let's talk about the M&A market in the AEC space since March 1st and the impact of COVID. Think about COVID, of course, it's among other things, obviously it's a health emergency, and it has resulted in a government response that's resulted in lockdowns, business closures, travel restrictions, etc. And with that, there has been, I would say, a public response that's been across a very broad spectrum, from some in the public ignoring guidance and actually protesting against the restrictions, to others following to the letter of the law, and then some for safety and protection. Well, I would tell you that we're seeing a similar broad spectrum of responses in the M&A market, but I will tell you that in general, the M&A market continues to be very, very active and busy, and the hot markets that I mentioned before continue to be hot, and we are moving forward. Now, just from a standpoint of this so-called broad spectrum, I will tell you that in some of our sale engagements that we have ongoing, we have several going, some strategics buyers and some private equity went on hold in March and April. And the general feedback was it's not that they didn't like the target anymore. They were doing it for other reasons. You know, private equity firms that went on hold said, geez, we've got a portfolio of companies that we need to spend more time on you know, the so-called routine daily maintenance, applying for a PPP loan. We've got to mind our store and go out of the market for a couple months. Same with some strategics. We had one strategic buyer that said they went on hold for 6 months because they wanted to basically, you know, squirrel the cash as a reserve because they were seeing some a downturn in their own business. But I will tell you that in general, and we have many sell-side engagements going on, there have been plenty of buyers before March 1st, and there are plenty that are charging forward, and we have deals that are continuing to move forward towards closing. We closed the deal of an MEP firm in Costa Rica to a large public U.S. conglomerate. It closed middle of April. It closed while Costa Rica was in a complete shutdown. The borders were closed. There was no travel. The entire process was, of course, virtual and remote. Buyer and seller was still interested, and we closed it in the midst of right in the, you know, what I would call the brunt of the most strict shutdown requirements. We have other deals going in the U.S. across engineering and environmental, where we've seen some buyers go on hold for a month or two, but those buyers have come back right around now. In general, I would say the process has slowed down a little bit as buyers are being a little more careful. And some processes have been slowed down by travel restrictions. The M&A process typically can be managed to a great extent virtually by phone, conferences, and emails. But typically buyers, before they write an LOI and sign up and commit to buy a company, they want to, you know, look them in the eyes, meet with them, not only have a face-to-face meeting, but also go out for dinner, social, and get to know them. So that's held us up a bit. But I will tell you, in general, our deals are moving ahead. We have a large design build firm that we have an international buyer that has yet to meet the sellers. They issued an LOI 2 weeks ago based on Zoom conferences. Wasn't what they wanted to do, but they're anxious to move ahead. So again, you know, things are moving ahead well for us.
What do you think, Karl? That's a great segue into the next element I wanted to get into here a bit. How's the actual, let's open the hood a little bit, how's the actual transaction, or is the actual transaction structure, kind of the composition of the different elements, is that seeing that change at all, or are they coming together the same way they did before the crisis?
No, that is a judgment call between buyers and sellers. I must tell you that obviously part of this process has been very dynamic. As you can imagine, we were engaged with buyers with information memorandums or prospectuses, if you will, that were published in February and March that included historical results for the last 5 years and a forecast for 2020. Well, guess what? As we've gone through this, you know, conversation and, you know, meetings and assessment process, the 2020 forecast went out the window in March and April when the economy got shut down. So there has been a lot of scrambling to rebuild 2020 forecasts and a very hard look at the impact of COVID by the buyers on the selling companies. And generally, we've had the good fortune of, we've had a lot of strong companies that are weathering the storm well. They have outstanding, in general, really good financial reporting and financial management tools that showed themselves well through this process, which gave the buyers comfort. And there have been some adjustments, obviously, in the forecast for this year and some reconsiderations. But in general, the buyers are moving forward. We have a couple of deals that are going under LOI this month, others that we're in the process of closing or at that point in the next month or so.
Are you seeing, Karl, this is a question that came in that's a really good point to talk about. When you're looking at financials and looking at actual performance for, let's say, the first quarter, or in this case, I guess more like the first half of the year, profitability, adjusting for PPP money that may have come in, how are you dealing with that and looking at the operating profit?
So we are, in general, we are showing financials two ways, with the PPP loan and without it, because this is a very unique and challenging situation, but it does create a problem for buyers that sellers need to be aware of, and the advisor is facilitating. Our goal is to facilitate a fair process with full disclosure and work something to the satisfaction of both parties. But keep in mind that, the normal convention is a buyer will go in and look at the last 3 years of adjusted Ebitda as a measure of their cash flow. They will try to project it forward based on that track record. And in a normal, stable world, it's typically pretty easy to take a look at 4 years and do some triangulation and extrapolation, if you will, to kind of project the future. Well, the buyer does not get last year or the last 4 years. The buyer is getting the rest of this year and the next 5 years. So the COVID problem is creating challenges and risks to buyers because they've got this big question, what am I getting and what will it look like? So it is very much incumbent on the sellers to create and present an accurate story of what is the COVID impact and upset impact on the business right now, and what will the business look like going forward after COVID runs its course. Now, needless to say, that none of us in our lifetime have been in a more difficult time when it comes to forecasting the future, because there is so much unknown about COVID and what goes with it around a relapse or the time duration or the impact on the business. So it is a challenge. I will tell you that some buyers have reduced their offers they've changed their term sheet and going to an LOI in the midst of the March, April, May timeframe, where we've come up with new forecasts that may be down a bit. Others have held pretty close to where they were. And I will tell you that in general, because we have, I would say, we have some clients that are weathering the storm quite well, and some buyers that have the confidence level to see that, and they're marching through it. We have several deals that are moving forward to close.
What about, one of the things that was a big change with the Great Recession was much more common use of earnouts to bridge the gap. And
Sure.
Can you tell me a little bit, maybe first kind of define what an earnout is, and let's talk a little bit about it. Are you seeing more of that? If so, how are they being structured? Those can be a double-edged sword.
To talk about, first of all, at the highest level, standard deal structure in this industry is typically 50% to 70% cash at close, with the remaining 30 to 50% made up in some form of deferred payments that can be seller note over 2 to 3 years, rolled equity, which will be redeemed later down the road based on the buy-sell agreement or whatever stockholder agreement is entered into, or an earnout. An earnout is like a seller note in that it's paid later. The difference with an earnout is a seller note is a so-called a company guaranteed payment. We'll pay you $3 million over 3 years with 5% interest. It's a loan, okay? An earnout is contingent on future performance. Sometimes they're used in the past in a stable, normal market to bridge a gap between buyer and seller valuation expectations. In the case of COVID, say a company is going along at $2 million Ebitda for 3 years, flat and stable, and steady should go 5 years. And now COVID's come and there's going to be a hiccup and their Ebitda is going down by $500,000, say, whatever. You might find a buyer who will pay a valuation at closing based on the COVID dip, and then provide an earnout saying, if over 3 years you get back to your original $2 million, if you do that, we will then pay you the extra payment price for that achieved value over that time period. So that's how earnouts work. We haven't seen we're talking about earnouts on a few deals. We don't like them to be a large component of deals, because one of the problems with earnouts is you surrender control at the closing. So there's always this conflict of interest of, how can I be graded if I'm not in control? And I'm putting my purchase price at risk when someone else owns the company, number one. The second challenge is, if integration with another part of the buying company is the goal, you can't do that because you need to keep it as a separate division for this Ebitda scorecard during the earnout period. So it's a obstacle to integration goals and the one team goal of putting the companies together. So I would say that, the deals that we've had in progress so far, we have one there's $1 million of earnout and a $12 million purchase price. And that's, I think an okay one. We're not looking for them to be a big piece of purchase price. What we are doing more, though, is we're doing more equity rolls and more private equity and family office recaps right now. But there's no question. Remember, we just happen to be blessed with some very strong companies that have had some quite resilient situations going through through COVID so far. I would tell you that if there is a hiccup, and say your profit goes down by 50% this year, a seller has a couple of options. Sell lower, because a buyer is likely going to want to pay on this year's profit or expectation. You can wait for the rebound, or you can work on a structure that hopefully can create a win-win, where maybe you sell somewhere in the middle with an earnout that can get you back to where you belong. So the answer is, it's all negotiable. And sure, I expect earnouts to be used more and more as this plays out.
Okay, thanks, Karl. So, one of the things, too, I heard a lot about last year, the year before that even, buyers who were looking to fill strategic gaps and strategic holes, to be more diverse, to achieve their growth objectives. It seems like there are still buyers where that is the case. What's the number one thing you think they should be looking at to early on flush out whether this is a seller that has the best of its years behind it, or this is a seller that's just going through kind of a very temporary sort of downturn? What should the buyers ask for first?
Well, one of the things I'd be really careful if I were a buyer is make sure you're coming into a situation with really good financial reporting. In these types of situations, I think understand financial reporting and forecasting and backlog, and the strength of the customer relationships are things that I would be paying even more attention. We'd always emphasize and think that's a great idea, but I think it's more so the case in this COVID market.
A question that came in, and by the way, guys, keep these questions coming in. There's some great ones here in the Q&A. Almost as like another way to bring up that issue I was talking about. How do you tell a seller that's just selling now because things are bad versus a seller who is actually thinking about going to market even before the crisis hit? You know what I'm saying? It's sort of who are the sellers who are realizing that they've got a problem here and got to get out versus the one that this was part of a strategic ownership transition plan?
Well, I guess if the question is, should I sell now, I would answer that, first of all, there are plenty of buyers out there that are active right now. On the engineering, environmental, construction services side. There's no need to wait from the standpoint of lack of buyers. There are plenty of buyers. I will tell you, remember I mentioned earlier that some buyers have gone on to hold. I also had many calls from private equity and family office contacts in March and April. Hey, Karl, just reaching out to let you know we are actively buying through this COVID situation. Please make sure to keep us going on your deal flow. We're ready
How does that kind of unfold, Karl? Is it? I mean, it seems like so much. One of the things we've always talked about for years is that you're buying. It's a people-based business. So, you're buying kind of culture. You're buying a lot of intangible value. So, are you seeing kind of? It used to always be, hey, you know what? The best way to assess is let's get these guys together and break bread over dinner. And are you seeing kind of virtual Zoom introductory meetings and things like that?
We are, and it is slowing down the process, but we are coming out of a little bit of this kind of travel hold. We do have an in-person meeting scheduled for next week with one of our deals, where the buyer went on. We had a very interested buyer that went on hold the first week in April, and they came out of hold the first week in June. They were in a 2-month COVID hold, and they are very actively interested in jumping on this deal, and we've got a in-person meeting going next week. So I think the in-person meetings are starting to happen, although the international buyer for another firm issued the LOI because the international travel restrictions are expected to last longer. And we did a couple of Zoom conferences. It's I think people are changing. They're making some adjustments, including their willingness to take some risk on some things.
Sure. Do you think another? I'm sorry. Go ahead, Karl.
We always recommend culture fit is the most important part of success in any deal in this sector. Culture, goals alignment, and values alignment. And those things are best understood in face-to-face meetings and with dinner to follow. So we do expect some to be slowed down by that, and we are seeing some slowdowns. By the way, we also expect the process to slow down due to the PPP loan program. If you are a firm that obtained a PPP loan and you want to sell, you want to make sure that the sale process doesn't interfere with your ability to apply for and get approved for loan forgiveness. And one thing for sure is you need to meet all of the forgiveness criteria and timetables before you enter into an agreement. So we are working. This is something that, as advisors, we're working very closely with the legal counsel and the banking representatives of the clients to manage these to their best outcome in an efficient way.
Are you seeing, Karl, buyers coalesce around any general kind of agreement? When they're looking at sellers, you're talking earlier about forecasts, and we've talked about dips and things like that. Any sense of when buyers feel comfortable of when we will be back to kind of normal revenue? I mean, obviously nobody has a crystal ball on vaccines and all that kind of stuff, but are buyers generally thinking it's reasonable to say, 3 months, 6 months, 9 months?
I think that's quite variable. I think that we're certainly seeing, first of all, private equity and family office investors are very active looking for deals. I guess I would say with the strategics, I think you've got this local thing where different states have different regulations and different restrictions. And there is a geographic or, state by state thing that has some impact as well. So
it seems like client market, there's some that have some pent-up demand that some don't. That would be a very variable kind of forecast. But hey, look, if you're saying that, especially private equity is probably a good bellwether to show if they're wanting to get back in the market, they see a light at the end of the tunnel somewhere. They don't see this as being a Great Depression.
most of the people that we're hearing from on that side are seeing this more of the the spike and a fast recovery is their general sense.
Mm-hmm.
Of course, that's why they're in the market. Perhaps the people that have other feelings are sitting on the sidelines and waiting.
Mm-hmm. What about, so here's another interesting angle to look at this for sellers. You've mentioned Ebitda a couple of times, which for those of you who don't know, it's earnings before interest, taxes, and depreciation and amortization. It's essentially kind of an operating profit measure, which really, really does drive valuation on so many levels. But are you seeing sellers who are kind of rethinking, obviously one big operating expense is rent and office space, that if we're moving into this new work from anywhere, a lot of companies that historically were really brick and mortar kind of architecture or engineering firms getting thrust into this work from anywhere model, and it works. Do you see them kind of revise projected expenses with lower real estate expense?
We have one client that's for sale that's reducing their footprint by 40% on July 1st, and they found that their working remote is fine. They don't need the large footprint. It's a
wow,
PMC.
that flows right to the bottom line, right?
Yeah. So I think others are still perhaps a little bit too early to, I think it might be just too early in that process to say for sure. I think what we've reinforced with our sellers is try to manage your financials to the best of your ability through this process to minimize the hit, but also maximize your strength coming out of it. We have some strong clients that are hiring aggressively through this downturn because they see more talent on the market.
Mm-hmm. Mm-hmm.
Design build.
Yeah, we hear that a lot, even organically, that this is a great time to hire talent.
Great time to hire right now. They've hired some people they never thought they could hire with some experienced talent that has not been generally on the market. So,
yeah. Karl, let's talk a little bit about finding. So, we've talked about, okay, sellers or buyers realize the market has not come to a screeching halt. It isn't the fold option necessarily. That there is some courtship and transactions actually happening. One of the biggest concerns with sellers is confidentiality. How do they initiate this process and find potential buyers who might be interested in their firm without potentially significantly damaging their brand or word getting out that they're for sale?
Well, obviously, if they hire an advisor can go out on an anonymous basis and use a sanitized teaser, is the term we use in the industry, to approach prospects without revealing the identity and kind of give them a generic a so-called bio or resume on the company. We call it a teaser. Get them under an NDA that, among other things, requires them to keep the process confidential. And we generally find that, certainly with private equity and family office, the understanding of that, the breaches in those areas they almost never happen. They happen very rarely, even with strategic buyers. Now, if you're a seller looking to do it on your own, you're going to have to call them up. So I would change the wording a little bit. I would call them up and say, hey, I'm for sale. I'm looking to retire. Do you want to buy my firm? I'd, kind of dance around a little bit, say, would our firms, be more powerful together? Is there an opportunity to put the firms together? I'm only, I'm not for, you kind of come across like you're not for sale, but you would do something with them because you don't want them walking away saying, the company's for sale. Because you can't have that conversation without an NDA, of course. So that's
sure.
That's the standard approach if you want to do it on your own, which is fine. I mean, I think it's just it's a positioning of the conversation and being careful about who you talk to and how you have that conversation.
One of the questions that came in, we were talking about earnouts and ways to kind of keep the transactions moving forward here, even though there is certainly a heightened degree of uncertainty than there was a few months ago or 6 months ago. So the question is, from the acquiring side, with the goal of integration and growth, and we've heard from several mega firms over the years who have said we are absolutely against earnouts for the reasons that Karl mentioned. They're more divisive than than bringing people together. So with the goal of integration and growth, any other suggestions for how to kind of commit to success as opposed to hedging against failure that don't add significant and unnecessary risk? So kind of maybe some other creative ways besides earnouts to kind of focus on success but also avoid too much risk.
Well, another way is to roll equity. If you're a company if you're a strategic buyer that has your own buy-sell agreement and internal ownership and an internal transition program, you can acquire another firm with some cash at closing, some seller note, but also some rolled equity where the selling shareholders redeem those shares for shares in your company. And what they're doing is, they are, they're putting skin in the game and with ownership interest.
That seems like it would also preserve cash for the buyer too, right?
Sure, absolutely. And it could help create a win-win and an ownership culture immediately that can be also helpful. There needs to be some, if your buy-sell is at a discount, they would need to have their shares, paid for at the same discount because they'll be required to sell down the road at that same buy-sell agreement, which may result in some internal fairness things. Especially related to any shareholders that may be redeeming in a year or two with this cash going out. We find those can be typically handled with a side letter to make sure any near-term redemptions can be adjusted if needed for the cash that goes out on an acquisition.
And just because it is, this always happens when we get in these periods of uncertainty. Like I say, you see some more earnouts. Can we just talk just for a minute for earnouts? What typical things are they based on? Is it always just top-line revenue? Are there some other things that you see out there?
I think it's better to have it revenue-based than profit-based because if you are acquiring a firm that has revenue from a client list that's totally different from yours, you can do a revenue retention earnout and still integrate because it's not driven by profit. So you can merge people, merge P&Ls, get total efficiency on office space and everything else. And the earnout is a simple one around retaining revenue of an identified list of clients that you brought to the transaction. Those types of earnouts, by the way, are helpful if you are a seller that has a special set-aside classification, such as an MBE or a WBE. Buyers are always concerned if you have, or a small business, if you are a special disadvantaged status and that is lost in the sale, buyers are rightly concerned about will the revenue stream stay. So that could be measured and paid on an earnout based on retention of those accounts.
Okay, thanks. We're almost at the top of the hour. Got a little more time. Let's flip a little bit here. We've been talking a lot about, looking at sellers and is it a good time to sell and what to be looking at to see if it's a quality seller, if it's down for now or down for good. Let's just, in the time we have left, I want to flip a little bit and talk about it. If I'm a seller and I'm approached by a buyer, especially right now, what are the things that sellers should be asking of buyers?
I always look upon this transaction process as a two-way interview, and the fit assessment should be in both directions for culture, goals, and values alignment. Because if you can't, if you don't have that, and you want to find that out early, that's number one. You want to make sure the culture, values, and goals fit is there, and then number two is, do you have valuation alignment? Mm-hmm. This industry, more than others, and I've been doing M&A for 20 plus years across many industries, this one particularly has a number of buyers out there that basically are on the low end of the valuation spectrum. There is typically a gap, that internal transitions typically trade 30 to as high as 70 or 80% below the external market value. And with that, I think that there are some buyers that have the sense that they may be able to buy companies with that type of discount versus market. So I would highly encourage sellers always to upfront and early in the conversation have a candid discussion about culture, values, goals. What are the plans for the firm? What's the plan for the brand? What's the plan for the leadership team? What's the expected transition timing? If you're looking to retire, how long do you need to stay and commit? But also have the conversation on valuation, because you can waste a lot of time and energy on getting to know someone to find out later that you've got a unsolvable difference of opinion on valuation. So get it out early.
What about, are there some ways that sellers can make sure that, a lot of times when a buyer approaches you, it might be a firm you've anecdotally heard of, but you don't have a lot of inside information, ways that sellers can make sure the buyers aren't a falling knife, that the buyers aren't in a position of stress?
Well, I think that one of the things, again, is sometimes when buyers knock on your door, that can be very positive, but it can also be they're looking for a bargain. So I would, again, say in those cases, first of all, the first question is, why are you interested in our firm? How does that fit with your strategic plan? What are your goals and vision for the combination of the two firms? And then tell us, where will the combined firm be in 5 years? And tell us about your culture, goals, and your values.
That's a good point, too. I mean, I guess if you're asking...
Yep, I'm sorry.
Okay, sorry.
I'm sorry, early on with the valuation discussion. We've seen buyers that we've had sellers call us and say, hey, someone knocked on our door, they love us, they want to buy us. I said, fine, ask them where their head's at on valuation. And you look at the valuation, and they want to put 10% down and term out the rest over 6 years, and the price is 40% below market, and we look at that and say, that looks like an internal buyout plan, and then you don't know those people. You have every right and ability to make a decision to provide a friends and family discount to your internal loyal long-term employees that you might consider part of the family, but you want to find out if a seller has that type of expectation so you can screen them out soon. I always think that if a seller requires you to stay for 3 years and then retire, one minimum price threshold very simply is, what if I just stayed, ran the business, put the profit in my pocket, closed the doors, and collected the receivables after 36 months? What's that number? Well, if the purchase price isn't above that number, why would you ever sell when you have to stay for 3 years and not get that profit straight?
Yeah. Certainly, if you can't make the case that pie is going to get bigger or there's some other strategic value, yeah, you're right. It's a no-brainer. Hey, along those lines, when you're looking at kind of aligning cultures, like I was saying, the questions that sellers should be asking buyers, one of the things that comes up from time to time, and I'd like your opinion on this, what if you have situations where the manifestation of a different culture is that project pricing, that one firm has been able to command a much higher value-based price, I guess, for their services than the other. Another manifestation of that is in compensation, that one firm is much more higher base salary, lower bonuses. How do you deal with things like that, disparities on project pricing or compensation or other similar matters?
That's all part of the due diligence that needs to be done before you finalize your offer, because you've got to remember the buyer's key mission is sustainability. What will they have after the closing and sustainable adjusted Ebitda cash flow going forward? What is their profit annuity going forward? And if there are elements that are not sustainable, they need to adjust their valuation accordingly. Sometimes we will have, small or mid-sized firms that have amazing profitability and low overhead. And it's interesting, some buyers will come in and say, well, the company's not worth that much to me because we would never run it that way with that low overhead. On the other hand, some buyers will come in and say, my God, how were they able to achieve this? We could learn from their leanness and their efficiency and their business processes. They could make us better. one of the things a buyer should always be looking for is if when you buy a firm, what attributes of that firm can add value to your firm. That's the so-called synergy in a deal. 1 + 1 = 3.
Mm-hmm.
Oh.
Yeah, absolutely. It's funny, several comments and questions have come in about watching out for firms that are kind of propped up by PPP money. And I think your point earlier, as we start to wrap things up, there was a good one.
You can't be looking at PP. Now, one of the things we talk about, valuation is all about Ebitda, but it's adjusted Ebitda. And anybody wants more detail on this, feel free to drop us an email. We'll send you a little slide deck or valuation 101 deck on valuation and why Ebitda and adjusted Ebitda is the gold standard of all M&A across all industries. But one of the things about adjusting Ebitda is you adjust it to normalize owner salaries to market. You adjust it for owners' expenses that might go away after the closing if they have some personal expenses on the business. You would also adjust it for rent if the owner owns the office in a different LLC and is renting it to the company at something other than market rate. So you normalize. These are really normalization adjustments. The other thing that goes into adjusted Ebitda, or what's typically anything that's non-recurring. So COVID, as a huge, hopefully non-recurring event, can be an Ebitda add back. But the problem is still the crystal ball problem. What's the future going to look like? I mentioned, if I am a $5 million Ebitda firm that is taking a COVID hit this year, and the adjusted forecast is $4 million. Well, I could see a buyer giving a pass saying, well, this is a non-recurring unique event. Let's add it back. But that's only if the question is, what will the new recovery level of Ebitda be after COVID runs its course? That's a $64,000 question for buyers and sellers to try to answer together, hopefully agree on, so a fair valuation and deal structure can be achieved. Yeah, that's where you get if you get alignment. And I will tell you, it's more difficult now than ever because you want to talk about a gyration, an upset to the system. This is something like none of us have seen in our lifetime relative to how difficult it is to forecast the future.
Yeah, and absolutely. That kind of ties into, it's the art and the science that comes together, mergers and acquisitions.
I know we're running close on time, but I did want to, I think one of the subjects is what's COVID doing to M&A. I do want to say the M&A market is vibrant and strong. There are active buyers, with the caveat that architecture is difficult. I'm not saying it's impossible. It hasn't gotten any better that I'm aware of, but there are plenty of active buyers at this point in the COVID thing, and there are many months to go. I would not hold back from going into the market with the caveat being is if you've had a huge hit, then you may want to think about waiting until you get a better handle on a clear picture of what it's going to look like when COVID's over. We closed a deal in an engineering firm late last year where the deal was delayed a year. During the negotiation and after the LOI, the company had a hiccup and went down 20% in Ebitda. The buyer said, hey, guess what? Our price is going down. But we'll be here in a year if you want to come back and fix it. The owner said, I want to wait and fix it, get the price. Well, he waited a year, he fixed it and got another 20% above the rebound, and it sold last year at a higher price than the initial offer, but a year later. So, think about that as you're a seller. I'd say, I don't think it's necessary to wait, unless you feel like you're having a huge hit and there's still more months to go before the future is clear.
Mm-hmm. So it seems like the hold and fold option isn't necessarily the one that many firms are making. It sounds like there's a lot of buy and sell.
You asked the question about the fold or the, be careful not to catch a dropping knife. I would say that those companies belong in a profit recovery program. And I would be I'd suggest not to, PSMJ has some financial, we have some turnaround consultants that have profit recovery experience to help you go in. I would think that you'd be better suited to do it on your own or get some outside help to go into a profit recovery program before you go to market. Otherwise, you're going to be selling low.
You bet. All right. Well, Karl, thanks so much for joining us. A couple of quick things. I did mention, you'll get an email tomorrow with a whole bunch of info, including I wanted to mention that PSMJ has a new product, AECmatch.com, that makes it a whole lot easier for buyers and sellers to find each other. So be sure to check that out. I'll include a link to it in the follow-up email, but check it out when you hang up here, AECmatch.com. To put buyers and sellers together to kind of make transactions happen. I think the one biggest thing we've taken away from our discussion with Karl here, it sounds like that's still happening. There's still buying and selling going on out there. So, Karl, thanks so much for joining us today. Thank you, everyone, for giving us an hour of your time. We hope you have an enjoyable afternoon and hope to hear from you or see you again soon on a future PSMJ program. Thanks, everyone.